A lot of people understand what a covered call is, right up until they actually try to place one. This is where the confusion starts. So in this video, I'm going to show you exactly how to place a covered call step by step on a real broker platform. And then I'm going to show you how the same trade is going to look on Thinkorswim too. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. In the last video, I explained what a covered call actually is. In this video, we're doing the practical part. We're not talking theory here. We're actually placing a trade step by step. Before you place a covered call, there are really 4 things you need to know. First, you need to own at least 100 shares of a stock or ETF. Second, you need to be willing to sell those shares at a strike price that you choose. Third, you need to choose an expiration date. And fourth, you need to choose a strike price that you're willing to sell against. Once you understand those 4 things, the actual order entry becomes a whole lot easier. Now here I'm going to take you to the brokerage. Right now we're in Robinhood. This is the desktop and your phone version. First I'm going to select the stock that I want to look at. Robinhood, why not? Go to the options chain. And in here, you're looking right now at the expirations. They're taking you down to 2028 currently. Now I'm not going to go out that far for this explanation, but we're going to go about 13 days out for this example. You also want to make sure that you sell a call, not buy a call, because we're selling a covered call. And when you sell it, you want to make sure you click that. Here we see the current price of the underlying asset. And then on the right, you're going to see the premiums. This is how much credit you're looking to get. Now, if you were buying, this would be a purchase, but seeing that we're selling, this is the credit. On the left, these are the strike prices that correspond to that. Now, what I'm looking for is an approximately a 20 delta. Well, what 20 delta is gives you 2 things. The 0.2 delta tells you that for every dollar the underlying moves up, your option will move up 20 cents. That's the 0.2. It also gives you an approximation of a probability of win. So if you're buying that option, you get a 20% chance to win that trade. Now we're option sellers, so we get an 80% chance. So there's an 80% probability of winning that trade based off of our 0.2 delta. Here I'm going to choose the strike price that I want based on a 0.2 delta, and this is the option that I chose. Now up here you're going to see a bid and ask. This is called the spread, and you don't want to choose a number on the bid side or the ask side, so I choose something in the middle. I want to get as much premium as I can, but I also want this to be filled. And if you choose one or the other, if you choose the bid, you're going to kind of shortchange yourself a little bit. If you choose the ask, you're not going to get filled. So this is where you see how much premium you're going to get. This is how much everything kind of costs. And down here, you're going to see how many shares you have available. So I have 300 shares, so I can go with 3 contracts on this particular trade. After that, you're going to see the price, you're going to see how much credit you can receive, you're going to be able to see the profit and loss graph. This kind of gives you some kind of a little graph. Robinhood gives that to you, gives you how much you can expect to win or lose, and you hit the execution. This is the final ticket, you hit execute, and you're in the trade. Now this is where we're going to get into where the Thinkorswim platform is. It's a little different. You choose the price, you choose the date, and this is what the option change looks like on Thinkorswim. It's a little different. Now I'm choosing the 77 strike because we already decided that that's where we wanted to be with that option. You want to make sure that you're placing that on the bid and ask and on the call side. So you have call sides on the left, puts on the right, you have your bid and ask. And because you're trying to sell something, you're always clicking on the bid. You're selling. If you click on the ask, you'll buy. I go in the middle at 81 cents. I want to look at this. Then it pulls up an actual ticket for you. This ticket is something that you can go over, like what it's going to cost you to place the trade, how much buying power it's going to reduce your buying power, and then once you're satisfied with everything in the trade, you just execute the trade. You can see on the left here that the trade is actually working, and you can check different tabs, a monitor tab and everything else on Thinkorswim here too. Once the trade is placed, one of two main things can happen. If the stock stays below your strike price by expiration, you keep the premium and you keep your shares. If the stock price finishes above your strike price, your shares may get called away at the price that you chose. And that's not by mistake. That's part of the agreement we made when we sold that covered call. And again, you still keep the premium that you received when you put on that trade in the first place. Now, here are a few beginner mistakes to avoid. Do not sell more contracts than your shares actually cover. Your broker usually won't let you do that anyways. Those are naked calls, and we don't necessarily want to be selling without any kind of a covered situation. So you don't choose a strike price without asking yourself if you'd really be okay selling these stocks at that price. Don't forget to make sure you're selling the call, not buying it. And don't forget that when you sell a covered call, you are actually capping some of your potential upside in exchange for that premium. But it doesn't necessarily have to end that way. It's a lot of times, if you're reading the market correctly, the market could be running sideways or slightly up, and everything can work out in your favor. Not always, but it oftentimes does if you have the right plan and right execution. So that is exactly how to place a covered call step by step. If this video helped make the process feel a little more simple and a little less intimidating, I'd appreciate it if you liked the video and subscribe to the channel. And if you want to go back and watch the previous video where I explain where a covered call actually is, then you could see that on the screen as well. On the next video, we're going to talk about choosing a better covered call setup. Thanks for watching. I'll see you in the next one.